Private sector economists are tipping Singapore's economy to grow by 3.5% this year, down from the 3.8% that was forecast earlier. Now, they're worried about a slowdown among Singapore's major trading partners, a sharper than expected rise in inflation, as well as an escalation in geopolitical tensions. Those polled by the central bank in its latest quarterly survey expect GDP to grow 3.9% on year in the third quarter. Now, that follows Q2's subpar growth of 4.4%. And for the whole of next year, economists predict growth of 2.8%. Effects of the external environment are already being seen in the city-state's key manufacturing sector.
What we do see is that the general slowdown in global manufacturing demand, especially after the hype of the semiconductors demand that was seen in 2021, this has very much slowed down year to date. The basis of Chinese slowdown, as well as the general weakness in the manufacturing demand, should actually be some of headwinds against Singapore's manufacturing as well as export growth drivers for this year, especially in the second half.
Meanwhile, residents here in Singapore can expect to pay more for goods and services for the rest of the year. Core inflation, which doesn't take into account accommodation and transport, is expected to come in at 3.8% this year, and that is up from the previous forecast of 3.4%. But there may soon be some respite, as economists expect core inflation to ease to 3.1% next year. While external risks remain going into next year, domestic pressures could also rise.
Wage adjustments does risk worsening the wage price spiral, and firms will likely be forced to pass a sizable portion of this wage cost to consumers because their profit margins are already narrowing because of rising costs, not just for labor, but for fuel, utilities, and rents. And also going into 2023, we have other factors like the GST hike in January. And also there is the GST expansion to cover imported goods, which is Economists.